Good morning. As we near the end of the chapters, chapters 16 and 17 are our last two chapters that we're going to discuss. I want you to have some takeaways from the course. In chapter 16, we're going to talk a little bit about the revenue cycle and current accounts management. And then in chapter 17, we're just going to talk about some financial conditions analysis. So my slide number 1 says, up to this point, our focus has been on long-term strategic decisions. Now we're going to talk about day-to-day decisions. Okay, decisions you make on a daily basis. So basically, this is just some general financial information, things that you may remember from your accounting classes and your previous managerial classes that you've taken thus far. Anytime you just stuff, these are just things I want you to remember. Anytime we talk about current accounts management, that involves all of your current assets and your current liabilities. The primary goal of having a current accounts, or the primary goal, shall I say, of current accounts management is for you to be able to support operations even at your lowest possible cost. And in some cases, in most cases, it ensures your liquidity, because you got to make sure you have adequate amount of current assets in order to adequately support any operations you currently have in your facility. So current accounts management is great to have. The goal of cash management is to hold the minimum amount necessary to meet your liquidity requirements. So when I say the word liquidity on slide number 3, I am referring to any bill you currently have in your facility that has to be presented to the business to operate the business. Okay? That's cash management. Your business should never be where you don't have lights, power, of any sort, water. That should never be. You ought to always, at all times, keep the minimum amount necessary to the point where you know all bills will be paid every month. We call this float management because basically that is what you're doing. You're floating from day to day, month to month, week to week, month to month. Net flow, that is pretty much the difference in cash based on what you have on the books and what the bank has, because you're making deposits. So you shouldn't have $3,000 more in your book, but your account at the bank doesn't reflect that. That means something's wrong with that. So that's what float management said. Float management said you should have net flow. Okay. Now disbursement float is, and I have it sitting right here on the slide. So, and I just gave an example. Suppose a family writes $2,000 in checks daily, but it takes 6 days for that to be received and cleared by the bank. That's called disbursement flow. Okay, because you're looking at about $12,000 in disbursement flow, meaning that you write $2,000 in checks daily, but it's going to take 6 days for that to clear. Now, on the flip side, same thing, but let's just say, for instance, you receive $3,000 in checks daily, and they're cleared in 3 days. We call that collection floats. So what will be your net flow? Your net flow is basically your disbursement float minus your collection float to give you your net flow, which is the difference of the amount of cash that you have on your books versus what you have in the banks. Again, don't have so much money on your books that's not coinciding with what you have on the banks, on the books for the banks. Net flow can be fluctuated by two things: accelerating receipts and slowing disbursements. Meaning that you're writing checks or you're writing this, but it's taking forever for it to clear the bank. But some other things that can be used for receipt acceleration would be making sure you deposit checks daily. That was just like one of my worst pet peeves ever when I used to write checks, is why do a company hold a check for so long? You should be making deposits daily. Daily. Even on Friday. Try to get to the bank before 6, because you do know that check gonna sit there all weekend long. Okay? Because guess what? The sooner it clears the bank, the sooner you can get paid. Just because a person writes you a check for $500 doesn't mean they have $500 in the bank. And in actuality, although you may receipt that, you don't necessarily have that until it has actually really cleared the bank. Lock boxes, concentration banking, clearinghouses, Federal Reserve wire system, all of these are techniques that can be used for receipt acceleration, which means that things that can pretty much go ahead and clear out any kind of check writing and things of that nature. Cash budgets. Why do you have cash budgets? We've talked about that. You got to be able to predict when you have a need, when you don't need anything right now, when you have funds available and you can do a temporary investment. Cash budgets are good for planning out how you operate your cash flows, and budgets just help you monitor cash on daily, weekly, and monthly agendas. Should depreciation be included in your cash budget? Slide number 7 says no. Depreciation is a non-cash charge. Only thing that should be appearing in your cash budget are cash payments and receipts. Now, depreciation does still affect your taxes. And the taxes is what appear also in the cash budget. Short-term financing. Okay, so you know what short-term financing, that means you have low administrative costs, and you usually have generally a lower interest rate because it's for a short-term amount. Okay, some of the people that greatly provide that type of financing for you, or major sources for that, will be your accruals, your account payable, and any kind of notes payable, or shall I say bank loans that you have. So what are accruals? We've talked about that before. These are wages owed to employees and taxes owed to governments. Accruals, wages owed to employees. And then the taxes you take from their paychecks, that's owed to the government. Those are accruals. Yeah, you have to pay taxes. Basically, that's what that boils down to. You don't, as a manager, you don't have control over how much tax is taxated to a person. That's a government thing. Your job is to make sure you cut the taxes and that you pay the taxes. Bank loans. We've already talked about this. Commercial banks. Those are important sources for short-term bank loans, usually given to providers who are running small businesses. When you have a bank loan that goes on your balance sheet as a note payable, and 3 things you have to keep in mind, 3 concepts. Promissory note. Okay, that's pretty much to make sure that's just like your loan term or your contract. Compensating balance, and then line of credit. Secured short-term loans involves collateral, where you may put the business up, the land, you don't pay, that they have a lien on it, they come and get it. Okay? Now that's pretty much it for chapter 16 in a nutshell. Okay? Chapter 17, the most important characteristic of a healthcare organization is its financial condition. Do you have the financial capacity to perform your mission? That's what you need to ask yourself. As a manager, you have to be very careful how you spend your money. I know some people say, oh, money spends the same. Not in every case, it does not. Slide number 14. A financial condition usually involves 2 techniques: financial statement analysis, operating indicator analysis. The statement analysis assesses your financial condition, whereas the operating analysis explains your financial performance. Okay, so the statement assesses it on paper or in a database, but the operating indicator pretty much lets you know or explains why you're in the financial situation that you're in. So slide number 15 is an example of a net income, of an income statement. We've seen these before. The next slide is an example of a balance sheet. This is just a quick review of what we've already went over in the beginning of the class when we was in chapter 3 and 4. Okay. The next slide, 17, is a balance sheet showing what liabilities and equity look like from over a course of a year between 2014 and 2015, what things are included in there. Then you have a statement of cash flows. And that was part 1. Part 2, this is cash flow and what it looks like from a financing activity. Now, when you're looking at your ratio analysis, things you want to ask yourself, 4 questions. Am I being profit? Is my business generating sufficient profits? Or am I just barely seeping by? Liquidity. Am I able to meet my cash obligations every month? Basically, am I able to pay my bills every month without the strain? Debt management. Am I using the right mix of debt versus equity? Okay. Do I have more debt than I have more equity? You always want more equity than you do debt. And then, do I have the right volume of assets for my patient volume? Meaning that, am I meeting my patient volume with the required or the correct amount of assets? My goods and my services, is it enough to suffice for the type of patient load that I have? Do I have too much or do I have not enough? Slide number 22 just kind of shows you how you would calculate total margin, operating margin. I don't want you to have to worry about that. You can read through it for your information. It's pretty much a recap from when you took healthcare economics, where you talked about return on investments, return on assets, but you're not going to have to do any calculations for that in here. Okay, occupancy rate, that usually applies more to hospitals where they're trying to keep up with the number of beds that they have. Now, that could also be a factor in nursing homes, assisted living, anywhere that involves beds that you actually give out to patients for a significant amount of time, and you needed to calculate up based on your number of inpatient, how many beds you have. If you was trying to figure up on average what that would be at a yearly rate, that's what the occupancy rate is about on slide number 24. Average length of stay. How long are patients staying on a daily basis? Okay. And then, how does that play a part in managers making a decision on which direction they need to go in based on the average length of stay? And like I said, you see this more so in hospitals and in places like nursing homes, assisted livings that have patients in different beds, and they have the longest length of patients and things of that nature. So most of the time when you see the average length of stay, it's pretty much in relations to individuals who are hospitalized upon admission. And again, that applies to hospitals, nursing homes, assisted livings, retirement homes, that's where you will see a lot more of this in play, being played out. Salary per FTEs, full-time employees, or full-time equivalents. Because guess what? The more beds you have, the more staff you have to have. The less beds you have, the less staff you have to have. And that's pretty much it for chapter 17. Like I said, I don't want you to worry too much about the different calculations. You can read through them in the book, but I don't want you to, you won't have to be responsible for that on a test. However, you will have to be responsible for the concept surrounding, average length of stay, the purpose of having it, the purpose of figuring out salaries per FTEs. Why is that so important? Because a lot of times that really helps you to determine how much staff you should have on hand. You never want to have a bunch of staff that's just sitting around drinking coffee, okay? Because they're drinking coffee and enjoying it, but at the same time, what you fail to realize, you have a set of salaries that you have to pay out for that. So you always want to look at those type of things, and you always want to adjust yourself accordingly. Okay, because it may be those times where you got more patients than you do staff, so that lets you know you need to hire. Then you may have just the right amount of staff for patients. So at the moment, you might need to cease hiring individuals into the facility. It's just looking at those things on a daily basis. Pretty much ties into any financial decision that you have to make. All right, well, that concludes again chapter 17 and 16. So the slides for 16 17 will be in Doc Sharing, but this concludes the audio lecture for that. Make sure you read back through the chapters for 16 and 17. Thank you.